Okay, so you want to build a rental property empire, buy several houses, collect the rent, have someone else pay down your mortgages, and retire early. That's the promise, and honestly, it isn't wrong. The mechanics are real, but here's the strange part. Most people who attempt this end up working harder than they did at their normal job. For less money, while carrying $1 million of debt, they can barely afford to service. The landlords who actually become wealthy aren't the ones who purchase the most properties. They're the ones who understood the math before buying anything. By the end of this video, you'll know exactly how rental empires are built from the ground up, what the money really looks like after expenses, and why the difference between a cash-flowing portfolio and a slow-motion financial disaster often comes down to one number most people never bother to calculate. We're going to cover what it costs to get started, how the revenue model actually works, the hidden expenses that can destroy your returns, real operators who built real empires with real numbers, the one pattern that keeps wiping landlords out, and what the actual profit looks like in two concrete scenarios. So, what does it really cost to get into rental property? Let's begin with one unit, a single-family home in a mid-tier market, say Columbus, Ohio, or Kansas City, priced at around $200,000. To purchase it as an investment property, you're putting down 20 to 25%. That's $40,000 to $50,000 in cash just to get through the door. Then you have closing costs, another 2 to 5%, so figure around $5,000 to $10,000. And you need a cash reserve, because the moment you close on the property, something can break. Assume another $5,000 minimum sitting in the bank, so your total entry cost for one property before collecting a single dollar in rent is somewhere between $50,000 and $65,000 in cash. Now, if you want an empire, you obviously need more than one unit. Most serious investors aim for at least 5 to 10 doors before they begin seeing meaningful portfolio income. At 5 properties averaging $200,000 each, you're talking about $250,000 to $325,000 in cash deployed just to acquire them, assuming conventional financing. Some investors use a strategy known as the BRRRR method: buy, rehab, rent, refinance, repeat. You purchase a distressed property cheaply, renovate it, pull your cash back out through a cash-out refinance after it appraises at a higher value, then roll that money into the next deal. It works, but it requires construction management ability, strong contractor relationships, and a lender willing to perform repeated cash-out refinances on investment properties. It is not passive. The alternative is commercial financing. Once you reach 5 or more units inside a single building, banks move you from residential lending into commercial loan terms. Interest rates increase, terms become shorter, and you often need a personal guarantee along with a business entity. The point is, reaching empire size requires either a lot of capital or a lot of hustle, and usually both. Okay, so how does the money actually move? Here's the model in a single line. You collect rent, pay the mortgage and expenses, and whatever remains is your cash flow. That sounds straightforward. The problem is, the gap between rent and expenses is almost always smaller than people imagine. Take that $200,000 house in Columbus. Renting it for $1,600 a month is realistic for a decent 3-bedroom property. That's $19,200 per year in gross rental income. Now, your mortgage on a $155,000 loan at 7.5%, which is a realistic rate for a 2024 investment property loan, comes to about $1,085 per month. That's $13,020 per year just in debt service. You have $6,180 remaining before paying a single expense. That's your gross margin. And now the numbers start getting uncomfortable. Property taxes on a $200,000 house average roughly $2,400 per year, although this varies dramatically depending on the state. Insurance for a rental property, not a primary residence, runs around $1,200 to $1,800 annually. You should budget roughly 1% of the property's value each year for maintenance and repairs. That's $2,000, and you also need to account for vacancy. Even an excellent rental will sit empty for a few weeks between tenants. Budget 5% of annual rent, so approximately $960. Add everything together, $2,400 in taxes, $1,500 in insurance, $2,000 for maintenance, $960 for vacancy. That's $6,860 in yearly expenses on top of your mortgage. Your cash flow on a $200,000 property renting for $1,600 per month, negative $680 per year, you're actually paying money to own this thing. Now, this is where people start to panic. And it's also where the model becomes more interesting, because that negative cash flow figure leaves out a few important things. Your tenant is paying down your mortgage every single month. Of that $1,085 payment, roughly $115 goes toward principal in year 1. By year 10, it's closer to $250 per month and continuing to grow. You're also receiving appreciation. Columbus home values have increased at roughly 4% annually over the last decade. On a $200,000 home, that's $8,000 in paper wealth created every year. And then there's depreciation, which provides a tax benefit. The IRS allows you to deduct the building's value over 27.5 years, which on a $200,000 property comes out to roughly $5,800 per year in paper losses that can be used to offset other income subject to income limits. So the complete picture isn't simply cash flow. It's cash flow plus equity paydown, plus appreciation, plus tax benefits. Real estate investors refer to this as total return, and with a leveraged asset, it stacks differently than almost anything else. The problem is, appreciation and depreciation don't pay your mortgage during a bad month. Cash is cash. So here's what smart operators actually do. They don't simply run the numbers on a property they happen to like. They work backward from their required cash flow target. They decide exactly how much they need to clear per door, and then they only purchase deals that reach that number. The standard benchmark is the 1% rule. Monthly rent should equal at least 1% of the purchase price. A $200,000 house needs to bring in $2,000 per month in rent. Very few markets achieve this at full retail purchase prices, which is exactly why experienced investors search for off-market deals, distressed properties, or markets other investors haven't discovered yet. And what about the costs nobody warns you about? The ones that truly derail investors aren't usually the obvious expenses. They're the costs that appear after you're already committed. Tenant turnover is the big one. Every time a tenant moves out, you can lose 1 to 2 months of rent. You pay for cleaning, painting, maybe replacing carpet. You pay for advertising. You may pay a property manager to screen the next tenant if you're using one. Total turnover cost on a single unit can easily reach $2,000 to $5,000. If you have a tenant who stops paying and refuses to move out, you're entering eviction territory. In a fast state like Texas, that can mean 30 to 60 days and $500 to $1,500 in filing fees and attorney expenses. In a slower state like New York or California, it can stretch from 6 months to an entire year. That's 6 months of carrying costs while no rent is coming in. On a 3-property portfolio, one bad eviction can erase a full year of profit, CapEx, capital expenditures. These are the big-ticket expenses that don't happen every year, but eventually will happen. A roof costs $8,000 to $15,000. An HVAC system runs $5,000 to $10,000. A water heater is $1,200. A complete kitchen or bathroom renovation on a rental can cost $10,000 to $25,000. Most new landlords budget for maintenance, but forget about CapEx. They're 2 different buckets. Maintenance is like oil changes. CapEx is replacing the engine. You need reserves for both. Insurance gaps are another major trap. Standard landlord insurance doesn't cover floods. It doesn't cover mold remediation beyond a small limit. One flood or serious mold problem can cost $20,000 to $50,000 out of pocket if you're in the wrong zone without the proper rider. Property management fees, if you hire a manager, usually run 8 to 12% of monthly rent. On a $1,600 rental, that's $128 to $192 disappearing every month before you receive a dollar. Across 10 properties, that's $1,280 to $1,920 per month, or as much as $23,000 per year, just so you don't have to manage the properties yourself. And then there's interest rate risk. Most investors who built portfolios from 2010 through 2021 did it using money at 3 to 4%. In 2023 and 2024, rates jumped to 7 and 8%. Anyone who bought near the top of the market with floating rate debt or needed to refinance watched their cash flow get crushed. Some went negative almost overnight, with no ability to increase rents fast enough to make up the difference. So who's actually turned this into a real business? Let's look at a few real examples at completely different scales. Grant Cardone is probably the loudest name in the space. He began with one residential unit in Houston in the late 1980s, lost money, sold it, bought it back, and eventually figured out the model. He shifted toward multifamily, buying apartment complexes instead of single-family homes. By 2023, his Cardone Capital Fund controlled more than 12,000 apartment units throughout the Sunbelt, with a portfolio valued at more than $4 billion. His argument has consistently been the same. Scale solves the pair-door math problems. A 300-unit complex can support a full-time maintenance crew and professional management. A single-family house has you calling a plumber at midnight. He raises capital from outside investors through private syndications, collects a management fee off the top, and earns a percentage of the profits when properties are sold or refinanced. His investors receive quarterly distributions. It works at scale because expenses per unit fall while income per unit remains relatively stable. Now, let's look at the opposite end. A regular person who figured it out, Brandon Turner, the former Bigger Pockets podcast host, began purchasing small multifamily properties in Washington state while still in his mid-20s. He bought a duplex, then a 4-unit property, then a 24-unit complex, all while continuing to work a regular job. By his early 30s, rental cash flow had completely replaced his income. His strategy was house hacking. He lived in one unit of each property while renting out the others, which allowed him to qualify for owner-occupied financing rates rather than investment property rates. Lower interest rates, lower monthly payments, and better cash flow from day one. He also purchased in markets other investors overlooked mid-sized towns with stable employment, cheaper purchase prices, and rent-to-value ratios that could actually reach the 1% rule. The common thread, neither Cardone nor Turner succeeded simply by purchasing what everyone else was buying in the hottest market. They found an advantage, ran the actual numbers, and scaled only after the unit economics made sense. And then there's the failure story, because this part is important. So, how do people actually lose their shirt doing this? The most common failure pattern in rental property isn't one bad tenant or even a collapsing market. It's being over-leveraged while carrying negative cash flow with no reserves. Here's how it happens. An investor buys 3 or 4 properties in a hot market. Prices are expensive, so cash flow is already extremely thin or even negative. They convince themselves appreciation will eventually make up the difference. They use minimum down payments on each purchase to preserve their remaining cash. Then, one of 3 things happens. A major repair appears, a tenant stops paying for 4 months, or interest rates increase and they need to refinance. Suddenly, they're losing $2,000 per month across the portfolio and their reserves are gone. They start making mortgage payments with their personal income. Then they turn to credit cards. Then one property goes into foreclosure, which destroys their credit and triggers personal guarantee clauses attached to the others. This happened to thousands of real estate investors during the 2008 crash. It happened again to a smaller group during 2023 and 2024 when rates increased faster than almost anyone expected. The investors who survived both periods shared one thing in common: enough cash reserves to survive the disruption and properties that were cash flowing from the beginning. The simple rule: never purchase a property that requires appreciation to justify the deal. Appreciation is the bonus. Cash flow is the business. Okay, so what can you actually walk away with? Let's run through 2 real scenarios using actual math. Scenario 1. The small operator. You spend 5 years building a portfolio of 5 single-family houses in a mid-tier market. Average purchase price, $200,000 each. Total portfolio value at purchase, $1 million. Cash invested roughly $250,000 across all 5 properties, including down payments and reserves. Average rent per property, $1,500 per month. Total gross rent, $7,500 per month, or $90,000 per year. Total mortgage payments across 5 loans at 7.5% on $155,000 each, roughly $5,425 per month, or $65,100 annually. Annual expenses across all 5 properties, approximately $35,000. That includes taxes, insurance, maintenance, CapEx reserves, and a 5% vacancy allowance. Annual cash flow, $90,000 minus $65,100 minus $35,000, that's negative $10,100 per year. Your cash flow negative by about $840 each month. Now, at current interest rates in most markets, this is unfortunately realistic. This is why experienced investors either go back further in time, purchase in cheaper markets, put more cash into the deal to reduce debt service, or use creative financing. But here's the equity picture. Every year, your tenants pay down around $7,000 in principal across all 5 loans. And if those properties appreciate at 4% annually, you gain $40,000 in paper wealth per year. By year 10, assuming 4% yearly appreciation, those 5 houses are worth roughly $1,480,000. You owe around $640,000 across the mortgages. Your equity, $840,000. You started with $250,000. That's a 3.4x return across 10 years, or approximately 13% annually, even though you were cash flow negative. Tax benefits add another layer, depreciation deductions, along with the ability to perform 1031 exchanges when you sell. Deferring capital gains by rolling the proceeds into a larger property can meaningfully improve the after-tax return. The cash flow problem can also correct itself over time. Rents increase with inflation, your mortgage payment stays fixed. A property that barely breaks even today might produce $300 to $400 per month in cash flow by year 8, as rents rise while your debt payment remains unchanged. Scenario 2, the serious operator, you begin with 1 duplex using house hacking, then scale aggressively over 10 years into a 20-unit portfolio, mostly small multifamily properties. Average purchase price per unit in a B-class market, $120,000. Total portfolio acquisition cost, $2. $400,000. Cash invested, approximately $600,000 over the decade, including equity recycled from earlier purchases through refinancing. Average rent per unit, $1,100 per month. Total gross rent across 20 units, $22,000 per month, or $264,000 per year. At this scale, with a property manager charging 10%, your management expense is $26,400 annually. Operating expenses and reserves, budgeted conservatively at 40% of gross rent. Total, roughly $105,600 per year. Total mortgage payments across a blended portfolio at an average 6% interest rate. Older deals are at lower rates, newer deals at higher ones, roughly $115,000 annually. Annual cash flow, $264,000, minus $26,400 in management, minus $105,600 in operating expenses, minus $115,000 in debt service, that's $17,000 per year, or approximately $1,400 per month in actual cash going into your pocket. That's not life-changing money, but add equity paydown across 20 units, roughly $20,000 per year in principal reduction paid by tenants, and appreciation at 4% on a $2.4 million portfolio, which equals $96,000 annually, and your total wealth-building figure reaches roughly $133,000 per year. By year 15, assuming 4% annual appreciation, the portfolio is worth approximately $4.3 million. Remaining debt, around $1.5 million. Equity, $2.8 million. Starting equity at purchase, around $600,000 invested. That's a 4.7x return, or roughly 11% annualized, plus the $17,000 per year in cash flow throughout the period. This is also where refinancing or selling a few properties becomes a real option. A 1031 exchange into a larger apartment building can reduce the per-unit management expense, increase income per unit, and push the cash flow numbers significantly higher. Operators who reach 50 to 100 units often discover that the economics change dramatically. At that scale, self-managing through a small in-house team can become cheaper than using outside management. A single maintenance technician, earning $50,000 to $60,000 per year, can handle repairs across 50 units that could otherwise cost $150,000 through individual contractor calls. This is why Grant Cardone's model focuses on 300-plus unit apartment complexes. Below 50 units, property management is mostly an expense. Above 100, it can start becoming a competitive advantage. There is one additional revenue stream that most small landlords completely overlook. Short-term rentals on part of the portfolio. A single-family property that earns $1,500 per month as a long-term rental could potentially generate $2,800 to $3,500 per month on Airbnb or VRBO in the right market. That's close to double the gross revenue from the exact same asset. The trade-off is management intensity. Short-term rentals require cleaning after every guest, continuous communication, dynamic pricing, and regular restocking of supplies. Most investors who operate this way either treat it like a real business, hiring a co-host or short-term rental manager for 20 to 25% of revenue, or they automate aggressively using smart locks, automated messaging, and professional cleaning crews under contract. Operators like Rob Abasolo, who has publicly documented his short-term rental portfolio, have built 10 to 15 unit STR portfolios producing $40,000 to $60,000 per month in gross revenue. After every expense and management cost, the net is still often 2 to 3 times what those same properties would earn as traditional long-term rentals. The risk? Local regulations. Cities from New York to Phoenix to Barcelona have moved to restrict or completely ban short-term rentals inside residential zones. Anyone building an STR portfolio needs to follow local ordinances carefully, because one regulation change can cut your gross revenue in half overnight. Let's also look at the historical arc here, because rental property math can look completely different depending on when you purchased. From 2010 through 2019, investors buying in growing Sunbelt cities, Phoenix, Austin, Dallas, Atlanta, Charlotte, essentially couldn't lose. Prices increased 60 to 100% during a decade while interest rates remained near historic lows. A buyer in Phoenix in 2012, who put $50,000 down on a $200,000 house, might have watched that property reach $380,000 by 2022. On paper, that's $180,000 in appreciation from a $50,000 cash investment. That's a 360% return before even including cash flow or tax benefits. That era made rental property appear almost unfairly easy. It attracted a massive wave of new investors who assumed those conditions would last forever. Then 2022 happened. The Fed increased rates from near zero to above 5% in less than 18 months. Mortgage rates on investment properties reached 7%, 7.5%, and even 8% by 2023. Monthly payments on the exact same loan nearly doubled compared with 2021. Anyone who purchased in 2021, near the peak of prices using high leverage and weak cash flow, got trapped. Rents couldn't increase quickly enough to cover the higher carrying costs. Operators who had to refinance variable rate debt faced brutal new terms. Some sold their properties at a loss. Some handed the keys back to the bank. The investors who survived were the ones who purchased cash-flowing assets, maintained strong reserves, and never assumed low rates would continue forever. The lesson isn't that rental property stopped working. It's that it only works when you operate it like a business with conservative underwriting, rather than treating it like a lottery ticket based on appreciation. The entire model in one sentence: you are using other people's money, your tenants, to pay down assets that you own while time and inflation do most of the work, provided you purchased correctly in the first place. So, here's the real answer. Can you build a rental property empire? Yes, absolutely. And thousands of people already have. But the path generally looks like this: 5 to 10 years of actively managing deals, reinvesting every dollar of cash flow, surviving at least one bad tenant or difficult market, and remaining disciplined while everyone around you is either panicking or becoming greedy. The small operator with 5 houses isn't becoming rich from cash flow at today's rates. They're creating wealth through equity, riding appreciation, and using leverage in a way that a normal stock portfolio can't replicate. The serious operator with 20 units is creating a real business with modest cash income today and serious wealth 10 to 15 years from now, especially if they continue trading up. And the people who actually retire from rental income, the ones you see on YouTube sharing their before and after stories, almost always built their portfolios before 2020 in markets that were inexpensive at the time, using interest rates that no longer exist. That doesn't mean you can't do it today. It means you need to be smarter, more patient, and more selective than they had to be. Because the dream isn't wrong. passive income from property is real. It just comes with a price tag most people never read before they sign.